Hi, it's more practice. Today, we're going to look at the 2021 Unit 1, Paper 2, Question 3. So go and get your copy and let's tackle this financial reporting and interpretation question. Hi, it's more practice in less than 15 minutes. Today, the 2021 Unit 1, Paper 2, Question 3. Financial reporting and interpretation. So go and get your copy and let's work together. All right, so the first question asks us to outline the effects of inflation on financial statements. And they give us two things to talk about, closing inventory and depreciation. So let's start with the closing inventory part of it. And what we do know is that the closing inventory, well, rather when inflation is high, the value of the closing inventory would increase, especially if you're using the first in, first out method, simply because the first in, first out method uses current prices. So any stock that you bought a long time ago will have to be valued at the current prices. So if those prices are increasing, so will your closing inventory. And surely, therefore, that reduces then the cost of goods sold, all right? Because obviously it's going to make it smaller, and by making that smaller, it results in a higher gross profit. Now, as it relates to depreciation is on historic cost. So inflation would mean that the cost of replacing the assets that we have is increasing, but depreciation is registering them at their historic values because we are creating a book value based on a cost that existed a long time ago. All right, so there's going to be a discrepancy between the book value and the real cost of the replacement value of those assets should we have to replace them. All right, so that was part A, part one. So let's go to part one. Part two says describe what is the current cost accounting method. And it says describe, so that's all it really wants, a brief description. Somehow the examiners have given you all the things that you might want to mention, so that probably didn't make it easier or more or harder, I'm not sure. However, current cost accounting is a form of inflation accounting, right? That acknowledges assets at their fair market values rather than their historic costs. So that would mean that when you are doing current cost accounting, you have to disclose the assets at their current market prices, right? You have to keep adjusting and presenting them at their current market prices. So that is part two of that question. So let's move to part B. And part B is asking us, as you can see, to define the term adjusting events. So what are adjusting events? What we do know is that any event that occurs between the year end, which in this case is December 31st, 2020, and the date of authorization, right, when they're going to be issued over to the shareholders and so, right, which is March 31st, 2021. Anything that happens in between there, right, that provides further evidence of conditions that existed on or before December 31st, 2020 in this case, that will be an adjusting event. If it occurs but it does not provide any further evidence, then obviously it's a non-adjusting event. So let's come down to part B of the question. So part B says, okay, we'll look at those three scenarios and see and tell us whether or not they're going to affect the financial statements. In other words, how would they be reflected? All right, so the first one says that you bought some share capital, right? And it was worth 600 million. But they didn't tell us that this seemed to have existed before, right? So the transaction to acquire the shares was not known. At least there is no suggesting evidence that this was the intent. All right, and therefore this should be there should be no adjustment for this on the financial statements. However, what we do see is that it is a significant event, right? It's very material, and therefore a note of disclosure and an explanation will have to be attached to the financial report so that the shareholders would know what impact this is likely to have on their future earnings, all right, at least the future of the company in any way. All right. Well, subsequent to that was the debentures. Now, the debentures, it says, were issued to cover a portion of the cost of acquiring Pain Limited. But again, it doesn't tell us if this was something in the works before the year ends. So I would also treat this as a non-adjusting entry, right? Because it seems to form part of that same transaction. Nevertheless, it does create an obligation for Taj Limited. And again, the explanation should be given as to how this will impact the business, especially as a going concern, since there will be this debt obligation, as I said, attached to it. All right. Well, the last one says, well, the valuation report of a property was received, right? And if I'm reading that right, was received would suggest that you had asked for it before, but you are now getting it, right? And it reveals that that is a permanent diminution of the value. So for me, the valuation was requested prior, and so it would be necessary to adjust the declared property value on the financial statements before they are approved for distribution by the directors. All right, so that's my take on part B of the question. So let's move down now to part C, and part C is a cash flow statement. So cash flow statement, as you can see, well, I set up a table to answer it because this will take a little time. And this is what they gave us. They gave us part of a statement, like a statement of profit and loss and changes, as well as a statement at the end that says that the company sold equipment costing $60,000 with accumulated depreciation of $42,000 for $24,000. So that is a significant statement that you must pay attention to. Anyway, so it asks us to, as it were, it says to prepare a cash flow statement, right? They're asking us to prepare a cash flow statement. All right, so how do you start a cash flow statement? You start with the operating profit. So fortunately, the examiner gave us the operating profit. So we don't have to worry about it. So let's move to make an adjustment for all of the non-cash transactions, because that's the second step in the cash flow using this indirect method, right? Adjust for all the non-cash transactions. So that would be depreciation for sure. And then it says, well, the disposal of an asset. So if we made a gain on that asset, we're going to have to subtract. And if we made a loss, we will add. So let's check it out. So I have a little working table over here. And so let's calculate the depreciation. So notice remember what I told you about the before, during, and after, because notice there's no mention of depreciation in this statement here. So I have to go back to the balance sheet. And the balance sheet has a beginning figure and an ending figure. But remember, we got rid of an asset. So therefore, we're going to look at the beginning, the during, and the after. So if I put it up over here, you see at the beginning, we had $320,000 in accumulated depreciation. And we got rid of an asset whose depreciation up to that point was $42,000. So if I subtract that $42,000, right, I should get, well, whatever I get, it says that I ended at 326. Now, clearly, 320 minus 42 is not 326. So that means that something happened between there, and whatever happened in between there will be the depreciation for this year. So you can see that 320 minus 42 is about 278 or thereabouts. And then we're going to subtract 326 from that, and it tells us that the depreciation for the year was 48. So 48 is our depreciation. All right. And then for the gain or loss, right, it says, well, the asset costs 60, had an accumulated depreciation of 40, right? And it was disposed of for 24. So 60 minus 42, sorry, will be 18. 18 is surely less than 24, so that means we made a gain of 6. So when we make a gain, according to this thing, you subtract. So we can subtract that gain. All right? So let's just add the totals and put in there. So next you go to the changes in working capital. So the change in working capital will be obviously inventory, receivables, all the other things that are listed under current assets, and the current liabilities, which would be the trade payables. All right. So we notice for the inventory, we move from 136 to 170s. And we know that if the current assets increase, we have to deduct. So therefore, from 136 to 170 is 34. So I'm going to subtract 34. For the receivables, we are moving from 109 to 97. So that means that that part is decreasing. And if those decrease, we must add. So we're going to add 12. The short-term investments started at 23 and finished at 50. So I mean we spent some more money. We spent $27,000 to get that. So we subtract. The payables, on the other hand, start at 156 and finish at 102. So that suggests that we paid off some of our debts, right? We paid $54,000 worth off in our debts. So we covered the changes in the working capital. All right, so we have that covered. So next, now we make adjustments for the short-term debt management. So what we want to do is make adjustments for the interest and the tax. So we have to check below because they have two figures here for interest and two figures for tax. And I'm just check here and see that it's also mentioned in the statement that there was interest and tax. So again, we're going to use that before, after, and during strategy, all right, to work it out. So let's do the interest. All right, so for my interest, I started at 11. Then the tax for that year was 17. So 11 and 17 is 28. But at the end of the year, my balance was 8. So that means that I paid $20,000 in interest. And I'll do a similar thing for the tax. All right, so I started at 15. The tax for the year was 77, giving me a grand total of 92, of which I have a balance at the end of 10. So therefore, I paid 82,000. So I can summarize my short-term debt management. All right, and so if I add all the entries so far in this column, that should tell me the cash flow from operating so far. So that's 162,000. All right, so now we come to the investing part of it. I know the part with the cash received from disposal because it told me up front that I got 24, so I don't need to do anything there. But what did I acquire? Did I acquire any assets? Well, let's work out and see. All right, so back to my PPE. It says I started at 940, right? And I ended at 920. Now I know that I got rid of an asset worth 60, so 940 minus 60. If I take that away, do I get 920? No. So that means that I also spent some money. So I would have spent $40,000. All right, so therefore, got that in there. And cash paid on the investment. So I started at 215 and I went to 253. So obviously I bought some more investments. All right, $38,000 worth. So I can add those up and get my cash for that. And then for my debentures, okay, there was just a simple case of subtracting, got 72. And for the ordinary shares, that went to 50. I paid dividends, as you can see, of 26. Therefore, the financing is for a year. And when I add all three of these together, I'm going to get the answer of 60, which I can prove to be correct by subtracting my cash. And there you have it. I'm sorry to rush it, but that's it. Thank you.